Hi, listeners and watchers. Welcome to our HVS chat. We are here today in August of 2026, talking with Bunmi Oyinloye. She runs our Houston office in the Consulting and Valuation Division of HVS and is our Houston expert. We are going to be talking all things Houston with you today, one of the largest and most important lodging markets of the country, and what is happening in this important market in the moment. We are going to start off first by talking a little bit about the background of the market, the history of the market, what makes it tick, and a little bit about its occupancy and rate. Uh, Boomy, with that, I turn the mic over to you. Thank you for being here with me today, and looking forward to learning more about Houston.
Thank you, Rod. Thanks for having me. Houston was a much stronger occupancy market a decade ago, with occupancy in the low 70s in 2014. But with the downturn in the energy sector and softer commercial demand, and while supply continued to grow, that placed a lot of pressure on the hotel performance for several years. So going through COVID, recovery was quite gradual. In 2023, the market was able to recover to 60% occupancy. And in 2024, we got a 4-point lift from one-time events, including a hurricane. And that from all that temporary demand, we got that good lift in 2024. But when we didn't see a reoccurrence of these events in 2025, occupancy, of course, moderated. So going into 2026, we're seeing a more normalized demand environment where year to date is year-over-year comparison is about 62%, pretty much very, essentially very flat and very minimal growth. So for the Houston market, we have had quite a prolonged period of disruption and recovery, whereby we've gone from being in the low 70s a decade ago to a market that just pretty much operates in the 59% occupancy range right now. And that appears to be stabilizing.
Okay. So, how has rate moved in that kind of a lower occupancy environment?
Right, the story has been not too different from occupancy. With the declining demand, we saw rate also be placed under pressure through 2019. But post-pandemic, we've seen consistent growth year over year, and especially, well, year over year through 2024. So with that elevated demand in 2024, we saw quite a significant growth. However, what is interesting is in 2025, we lost only $1, whereby ADR saw a modest decrease to 120 from 121 in 2024. So in year to date through June, we've seen a 6% increase in rate, which of course comes from the support of having 7 events in Houston from the World Cup, FIFA World Cup.
Okay. Do you think, I know none of us really have a crystal ball, but looking forward on occupancy and ADR for 2027 and the remainder of this year, do you do you think that those World Cup events were so significant that ADR might pull back a little bit next year? Or will it follow that trend of 2024 where you were able to hold on to that higher rate?
Well, June and July rate growth was pretty significant. So
Mm,
we do expect to see a pullback for those months, if
yeah.
not for the first quarter. We had upwards of 15% rate growth in June, and we expect to see something similar in July. So for those 2 months, we expect to see that pullback in 2027. So from my end, I am expecting, if not a flat rate in 27, maybe a modest decline.
Yeah. Yeah. Okay. All right. That makes sense. What about new supply. I imagine with occupancy now in that 59 to 60% range, finding feasibility in building new supply is probably a little on the tougher side.
It is.
Is that starting to show with lower supply growth?
It has been post-pandemic. We've seen um, a slower pace of development compared to pre-pandemic.
Okay.
2025, we had 900 rooms reported opening in the market and overall market, compared to when we were having over 2,000 rooms on an average pre-pandemic. Included in that new supply, we've seen a lot of mid-tier development as
Hmm.
economy segment and mid-tier development. We haven't really seen any larger projects opened in recent years. We had in downtown market a dual brand open last year, the Home 2 and the True by Hilton, about 220 rooms. In March 2026, we've had the Staybridge and the Holiday Inn Express dual brand open also in downtown with 275 rooms. However, in the past 3 years, we have seen increase in, renewed increase in upscale and luxury investment for the market. We have 105 Birdsall by Auberge under
Hmm.
construction right now to
Okay.
open in 2027. But that development comes with residential.
Okay.
So and we've been seeing a lot of feasibility with luxury projects being combined with residential components.
Yeah.
But in the pipeline going forward, we have about 1,600 rooms through 2030 being planned. And within that 1,600 rooms, we're also looking at a Rosewood being proposed for development in the Uptown District. That, of course, just like you said, with development cost, interest rates, a lot of developers would have to be very selective in the projects that move forward.
Mhm. I'm sure, like most metro areas, those key submarkets that just shine a little bit brighter than others, and maybe there's some opportunity there for development.
Absolutely. A
Yeah.
lot of the developments we're seeing in the upper tier segments are in downtown, uptown, the medical district, with other submarkets that mostly limited service and very few select service projects.
Right on. What about sales? Have there been too many transactions lately?
Well, Houston remains a very active market. Most recently, post-pandemic, we've seen more sales in the economy and mid-tier trading at under $100,000 per key. But we have had some notable higher tier sales in the past 3 years. To give an example, we had the Intercontinental at the Texas Medical Center sell in 2023 at $244,000 per key. And in 2024, we had the Hotel Grand Duca and Hotel Zaza sell at above 300,000 per key. In 2025, we had a three hotel portfolio trade at above 300,000,
Oh,
my
wow.
apologies, 300,000 per key. The portfolio included the Westin, the Embassy Suites, and Woodlands Resort, a Kuro Collection by Hilton property. And these hotels were also traded in 2021 at above 270,000 per key. However, at that time, the Woodlands Resort required a renovation, and that renovation was completed before this recent
Okay.
2025 sale.
Okay.
So in June, we haven't had a lot of notable, sales above 100,000, but one that does that's of a higher tier is the former St. Regis Hotel in downtown in the downtown district that sold for over 200,000 per key. And what's interesting about this project is that it's a legacy asset for the city of Houston.
Mhm.
But it's been a while since it's been updated. It hasn't been updated since 2013. So the um the buyer was able to get it at a good price point.
Yeah.
And the plan is to have that asset renovated and repositioned. So I'm looking forward to seeing what they do with that
Yeah.
property.
Yeah. A great basis for a luxury property. But you have to have that longer term view, don't you?
Exactly.
Yeah.
And
And
we do need a lot more of those type of assets in the city, but at the price points and the development costs with the interest rates, it's just been a lot more challenging having those type of projects be feasible.
yeah, I can see that. Well, wonderful. It has been a pleasure talking to you today about Houston. You obviously know your stuff. Listeners, watchers, if you want to connect with Bumi, her contact information will be on the screen here in a minute. I encourage you to connect with her if you have a project coming up in Houston or an investment you want to talk about. She is the person to connect with. Thank you so much for watching, and thanks, Bumi, for being with me here today.
Thank you, Rod.